and where they stand with respect to these 5 factors. I won't go too much into that, but I think there is enough over there for all of you in Sri Lanka to look at and work in your own environment and see how you can build on it. Finally, with respect to the same subject, as I mentioned, capital markets are very critical to financing growth. Quite frankly, for a country's GDP to grow strongly, so give you an example for, say, Sri Lanka to grow at 8 to 10% on a sustainable basis in the long term, you would expect to see a financial sector that's strong, emerging, so that it's able to finance these growth opportunities. Bond markets are going to be very important of that initiative. I saw that in the financial stability review document for Sri Lanka that there were 2 bond issues that took place last year. That's a good trend and clearly needs to grow several times, to get these markets grow. It's not going to happen overnight. It's a long journey. Typically, markets take 5 to 10 years to get there. If you look at Malaysia, Malaysia is a prime example of how a market has grown over the last 15 years and is now seen as a poster child for bond, other countries looking to emulate bond market development. Now, finally, the reason why I'm here is that Standard & Poor's has had a partnership with the rating agency of Malaysia since 2004. We are certainly very pleased with their investment in Sri Lanka, in Lanka Ratings, RAM Lanka. And there are 5 things that I think should come to mind when you look at why Malaysia is seen as such an important market in the way it has developed for bond markets. First, its size. It's the 3rd largest in Asia after China and Korea. The bond market is the corporate bond market is twice the size of India, so that should give you some context here. Second, a market needs to provide not just short-term financing, and what they've been able to achieve in Malaysia is bonds that are 10, 15, 20, 25-year bonds, and when you're looking to invest in infrastructure, that's the kind of tenor you need. You need bonds which have a maturity profile fairly similar to the asset profile that they seek to finance. The third, and it may or may not resonate in Sri Lanka right now, Malaysia is the largest Islamic bond issuance center in the world, much larger than the Middle East, and about 60 to 70% of all issuance in Malaysia takes place in the sukuk market. Finally, I should say that you also see a fair amount of issuers there. You don't see concentration. So give you an example, the top 30 issuers in Malaysia only account for about 40-45% of the total issuers in that market, which means that investors have enough opportunity for diversification. And then finally, foreign issuers and foreign investors have taken to Malaysia in a fairly big way. Now, the reason why I'm saying that is I think in the case of Sri Lanka, you're very fortunate to have RAM Lanka over here because they can piggyback on the experience of RAM in Malaysia, and RAM has been a critical part of the Malaysian bond market story. So here we are all very excited to be able to serve you, and with that, let me bring it to a close. So thank you all, ladies and gentlemen.
Thank you, Mr. Kathpalia, for excellent coverage on what lies ahead for Asia. The next item on the agenda is the panel discussion. I'd now like to cordially invite the moderator of today's panel discussion, Mr. Adrian Perera, to kindly take his seat on stage. I'd also like to cordially invite the panelists for today, Professor Lakshman Watawala, President, CMA Sri Lanka, Mr. Dheera Singha, Deputy Governor of the Central Bank of Sri Lanka, Mr. Preeti Jayawardena, Managing Director of Chemonex PLC, Mr. Krishan Balendra, President, Corporate Finance and Group Strategy at John Keells Holdings. I'd also like to invite Mr. Kathpalia to once again join us on stage.
Okay, today's theme is strong growth should counter challenges. And I think in that context, I would like to make some initial remarks on the progress that we have made in Sri Lanka as far as the growth is concerned, And we had a bad year in 2009, and the growth was around 3.5%, but that growth has increased to about 8.1% in 2010. And in the medium term, we are hoping that the GDP growth will be around 8.5% in 2011, and it will go up to, say, about 9% in 2012, 2013. And with that, I believe we need to have a strong fundamentals in other variables as well. If you look at the inflation, for example, Sri Lanka is one country which had high inflation. If you look at the situation since 1978 to 2008, the inflation has been around, on average, 12%. And that high inflation has now come down to mid-single digit level. And our external sector had a lot of issues. We ran into a virtual balance of payment crisis in 2009, and we were supported by IMF program, and that IMF program is now well on track, and we will be completing that program by end of this year. So with that, our reserves have increased to about 6.5 months of imports, and as far as the external sector is concerned, our exports have been growing, and some of you may have read in the news, the January 2011 export growth has been 72% higher in dollar terms compared to January 2010. And fiscal sector, I think we have a very strong consolidation process going on, and our fiscal deficit in 2009 was about 9.9%, and that deficit has been brought down to 8% in 2010. And what we are hoping, as far as the fiscal deficit is concerned, in the medium term, is for the fiscal deficit to drop to about 6.8% in 2011 and to be lower than 5% in the medium term. And in other macro variables, if you look at the conditions have improved quite substantially. The interest rates are very high, and interest rates have come down, and now those activities that were not feasible at high interest rates in the past have now become feasible. That has given tremendous impetus to growth. And also in the real sector, we see the situation since the war has ended in mid-2009, 1/3 of the land area has come back to the mainstream economic activity, 2/3 of the sea has come, and we have seen the impact on the economic growth. The fisheries output has grown around 20% during that period, and the agriculture is growing very fast. So all three sectors, agriculture, services and manufacturing activity, contributing equally to the growth, and the exchange rate has stabilized, so people can have more predictability in the case of exchange rate. Likewise, I think we are on a very, very strong growth path with strong fundamentals in this country, what we had more than ever before. So those are my remarks, unless you have questions.
Yeah. Can I ask Professor Watawala to give? Yeah. Okay. Then Kishan?
I'd like to thank the speaker for an excellent presentation. Very briefly, a couple of comments. It's very encouraging to see Asia now back on a fast-track growth path after the shocks in late 2008 with the global financial crisis. Some of the developments in Asia are having an impact in Sri Lanka. I think Mr. Dhirasinghe commented the risk of inflation with the recent floods. Food prices have gone up and inflation has ticked up. But the interesting development here is that with the end of the conflict, production in the north and east, in particular agricultural and fisheries production, is increasing significantly, which is countering the negative impact of some of the external shocks on inflation. The development of the capital markets from a private sector point of view here, we have seen in Asia an increasing demand for emerging markets debt. The sovereign here has issued, I think twice last year at attractive rates, US dollar bonds. But I think a number of corporates have done private placements of US dollar debt. But what is interesting is the increasing appetite in the region for local currency debt. We haven't seen a local currency sovereign global issue as yet, but that would certainly be a positive development if that happens, because the private sector can then follow the recent reforms with the budget in November, where foreigners are now allowed to invest in local currency corporate debt is a very positive development. And in recent meetings with investors, we have seen a strong appetite for that. So the developments that the speaker referred to in the region are certainly having an impact here. And it's an excellent opportunity for the private sector as well to tap that appetite that is out there now for corporate debt.
Thank you.
Yeah. Well, as how I see, I will just touch very briefly on the overview of the economic situation of the country today and how the rating agencies could help us to propel growth. Now, the problem we had was on the fiscal side, we had a budget deficit of about 9.5%. And that has been addressed at the last budget. We have been able to bring it down to 6.9%. We expect to bring it down to 6.9%. Now, but the public sector investment was just kept at the same level, 2.7% of the GDP. And what the policymakers wanted was the private sector investments to fuel the growth. So in order to give a impetus, what they did was they brought the corporate tax rate from 35% to 28%. So the companies are making good profits because the hostilities are lower. And now they have enough funds to invest, and the country wants the private sector investment to take place. But unfortunately, as Surinder very rightly said, that all the investments have been funded either by bank borrowing or by equity. Now, we all know equity is the most expensive source of funding. The bank borrowings are generally tends to fund short-term or a little bit of medium-term. So there is a mismatch. Because ideally, the long-term capital should be funded by with long-term credit. So that is why we have to develop this corporate bond market. All this time, we had only the sovereign bond market because it was confined only to the country, only to the government. But central bank recently have relaxed exchange laws, and they have opened doors so that the corporates, they also can now go out and get funds from outside. So the corporate bond markets should be developed. But as Surinder very rightly said, there is a gestation time, take a little bit of time. But we have to do that because ideally, if you take in developed world, all the developed countries, about 35%, 33, 34, 35% of the private sector investments are funded by corporate bonds because they come in as long-term capital, 10 years, 15 years, 20 years. So how should we do that? That's where the rating agencies play their role.
Now the floor is open for questions. So, Yes, Mr. Mansur. Yes, you can.
Can I?
Yes, yes.
Yes, I would like to ask two questions from our Deputy Governor, Mr. Dheera Singh. Please don't think it's a criticism, it's only a clarification. The speaker, in a very interesting address, drew attention to the problems connected with inflation, which is picking up all over the world, but more especially in South Asia. We are also facing inflation. While most of the South Asian countries, as mentioned by him, has tried to counter inflation by raising the policy rates, Sri Lanka is doing the opposite. We have lowered the policy rates and we are maintaining those rates. So I'd just like to have clarification as to what the thinking is. That's the first question. Second one is the exchange rate. I know it's a dilemma for the central bank and of course for the exporters. Exporters are bleeding when the exchange rate, when the rupee appreciates. The question is the rupee depreciating possibly because our reserves are going up. Now again, reserves are made up of hot money and foreign direct investments. From what we can gather, FDIs are not that forthcoming. Last year there was hardly anything. This year, except by selling land, the government has not really attracted FDIs, unfortunately. So, how much of these reserves have you assessed? How much is really money that will flow in and flow out very quickly? And how much of it, what percentage is stable reserves? Because I know you have very complicated exchange rate policies, but basically, if you are appreciating the rupee on hot money coming in, then when it goes out, we'll have a problem. Just a clarification on those 2 points, not a criticism.
First question on inflation, and I think we have to make this clarification. The inflationary pressure we see at the moment is entirely from the supply side, and we have clarified that to the public in a statement that in February the main source of inflation was the food prices. Those food prices are domestically produced commodities, and we have not adjusted the imported food items in prices. The oil price has not been adjusted, the milk powder, sugar and other commodities have not been adjusted. The entirety of the inflationary pressure came from domestic prices, and the main reason behind those price hike in the domestic market was the flooding that we had in some parts of the country. And we have seen the prices rising just after the floods. And after 2 or 3 weeks, the prices crashed down. Now you see in the market, the prices are much lower than the prices we had after the floods. And also, we are enjoying the benefits of the peace dividend. Most of the produce from Jaffna has come to the market, and as a result, the prices have stabilized. So all in all, what I'm trying to say is that the inflation we have seen in the last 2 months has been due to supply factors, and we need not get excited about it because vegetables are 2 months crop. So we will have lower inflation in Sri Lanka in May and June, and for the rest of the year 2011. By end of the year, we will have mid-single digit inflation in Sri Lanka. So we need not take any monetary policy action. Sorry?
Despite the oil price increase, you say it has single digit inflation?
Yes, and also the other factor we have to take into account in this equation is the expansion of the production possibilities of the country. We have got, as I said, 1/3 of the land area back in mainstream economic activity, 2/3 of the sea area has come, and all the other disruptions we had in the production processes have gone off and they are no longer there. We need to take into account those factors as well. So even with the likely adjustment, if at all, if they are going to be in the case of oil price and other prices of imported commodities, the inflation will remain in mid-single digit range. So that is one. So we need not take at this point of time any monetary policy action, because the price pressure we have seen in the past has not been due to any demand factors. There is no need for us to take demand management measures at the moment. And second question with regard to the exchange rate, I think we need not discuss any macro variable in isolation. We need to take the entirety of the macro conditions in the country. If you take interest rates and inflation also into the equation, together with the exchange rate, we have seen, as I mentioned earlier, the interest rates have come down from about mid-20s to about a level below 10%, and you can borrow from banks. And of course, I must also say that the comments made by Mr. Balendra and Preeti on the capital market, we need to develop the capital market, and there has to be active issue of debt, and the capital market has to develop. Despite that, at the moment we see most of the businesses are borrowing from banks, so bank credit has become very cheap, and inflation has come down. There is no wage pressure at the moment. Inflation around 20% earlier has now been reduced to about 7.5%. So if you take the advantages that the entrepreneurs get from the improved macroeconomic conditions together with the exchange rate, I think we are more competitive. And I said that in January our exports have grown 72%, and last year 2010, despite the exchange rate appreciation of about 3%, our exports have grown by about 17%, and our export growth in 2011 is going to be much higher. And mind you, this is despite the withdrawal of GSP Plus as well.